On behalf of Gradish Mahura Investments and Transformational Investment Portfolio 1, I would like to extend a very warm welcome to you on this cold winter's evening. It's very cold in Johannesburg, as I said, and I hope you're feeling a bit warmer wherever you are across the country. This afternoon, ladies and gents, we are going to talk about diversification with BEE schemes. Many of you will know that Gradish Mahura Investments has spent a lot of time over the last 13 years of the existence of our company talking about BEE schemes. But today is slightly different because we have partnered with Transformational Investment Portfolio 1 because we think ultimately it's a culmination of what we've been trying to do over the years as a company. So just to start off, just to let you know how the day is going to run today. Today, during the presentation to you, and I'm going to ask Lemao to please put on his video as well when we're doing this part of the introductions. The way the day is going to flow today is that you're going to have three presenters presenting to you today. The first one to present will be myself, Kagiso Mahura. As many of you would know, that these presentations in Gradish Mahura Investments were often done and are often done by Craig Gradish. Unfortunately, Craig has got a bereavement in the family, so he's attending to some family matters at the moment. So unfortunately, he's not going to be able to join us this evening. So I'll be presenting to you. I am the CEO of Gradish Mahura Investments, but also I want you to know that I'm also currently the chair of TIP 1 of the TIP 1 board. So what I'm going to do, I'm just going to do a very quick introduction on Gradish Mahura Investments, and then I'm going to take you through a couple of investment principles that we think are very important in considering when buying shares, these BEE shares, or constructing your investment portfolio in general. Whenever we've presented on BEE shares before, we've always said you've got to look at them in context. And what is that context is what I'm going to take you through as part of my presentation. And then really the real reason why you're here is going to be covered by Jeff Blunt. Jeff is the CEO of TIP 1, as we call it. Just to give you a little bit more background on Jeff, Jeff holds a CFA designation. He's worked as a lecturer at the University of Witwatersrand, lecturer on corporate finance in his past life. He's worked at Sasfin as an equity trader, and he's been around the block. As you can see, he's worked at BOE, he's worked at Investment Solutions, which was part of Alexander Forbes. In his capacity there, he was reviewing asset managers in South Africa, in the United Kingdom, and in the United States. Over the last couple of years, before he joined TIP 1, Jeff was the Chief Executive Officer at Cannon Asset Managers and also at Bay Hill Capital. And of course, currently now, he's the CEO of TIP 1. What Jeff is going to be doing, he'll be taking you through a little bit of analysis of selected triple BEE shares, and thus also building the investment case for TIP 1. So essentially giving you an understanding of how they go about doing the analysis and constructing the portfolio for TIP 1, and then ultimately why TIP 1 will benefit you as an investor. And then after Jeff, we'll have a very quick presentation from Lemao. Lemao is currently the financial director, CFO at TIP 1, and he was going to take you through the investment process. How do you actually go about registering to buy shares in TIP 1 should you be convinced that's the route to go? Just to give you a little bit of background on Lemao, Lemao is a qualified chartered accountant. He's had extensive experience in the market, in financial services, in management consulting, in BEE and tax advisory services. He also joined First National Bank in his past life as a credit and finance manager. And then he also worked on strategic projects at F&B. He then left to start his entrepreneurial journey, managing an investment company called Gabonala Investment Holdings, and also running a couple of family-owned businesses, before, of course, joining TIP 1 as the current CFO or financial director. Ladies and gents, the way the afternoon is going to run is that between the three of us, we're just going to take maybe just under an hour to present to you what we have to present. So as we are presenting, we're going to ask you to please, if you've got any questions, please post them in the Q&A box that you can see for most of us at the bottom of your screen. So we'd like to get as many of your questions as we go along, and then we'll address them at the end. We really want to make sure that those who do need to leave early at least get to see the full presentation and the core of what it is we are trying to present to you this afternoon. And as soon as all the presentations are done, we will then handle each one of those questions and try and go through as many of them as we possibly can. So without wasting any more time, I just want to take you through the agenda. On my side, I will, as I said, I'll talk to you about GMI and our history with triple BEE shares, where we've been and what we've done, give you a quick introduction on the company, on what we do as a business, and then take you through some investment principles you need to consider. Then finally, I will take you through why we have partnered with Tip One, taking you through some of the challenges and opportunities that exist in triple BEE public shares. Many of you will remember in 2008 when we started the business, that was when Zenzele was launching into the market. Way back then, we partnered with Kaya FM. To cut a long story short, we ended up at the Empress Palace with 1,500 potential investors in Zenzele, listening to Craig and myself presenting on the cash option and the finance option of Zenzele. Subsequent to that, the Black Management Forum had seen what we had done, and they roped us in to ask us to go and present to their members across the country. I remember we went as far as Kabili doing some presentations to BMF members. When Vodacom had seen what we had done with Zenzele, they then called us when they launched Yethu in 2009. The route they decided to follow was to do a national radio launch. So Craig and myself spread ourselves across the country, and we did various presentations on different radios, all the way from Hot FM in Cape Town to Ligwala Gwala FM. We did presentations to the public about Yebo, how it worked, where you could invest, and how to understand how it was constructed. Fast forward a few years later, 2018, MultiChoice contacted us to say we need to join them on a roadshow of their investors regarding Phuthuma Nathi. And this roadshow, once again, we were there presenting to the investors in Phuthuma Nathi, explaining to them the returns they have achieved in Phuthuma Nathi, how those returns were generated, but more importantly, what kind of choices they were going to have in terms of Phuthuma Nathi and the conversion of shares into MultiChoice South Africa. In 2019, Barloworld sold its property portfolio to another BEE scheme called Kula Sizwe. We went on a roadshow across the country one more time, explaining how this deal was constructed, what sits inside the portfolio, what the structures, the debt structures, etc., were, and how the investment process was going to happen across the country. Last year, just before COVID, we got a call from SAB, which is AB InBev, regarding the SAB Zenzele share scheme that they had sold or had been open only to their retailers, which is the taverners and shebeen owners across the country. They roped us in and asked us to present to these members what was going to happen with Zenzele, because that scheme was coming to an end. But of course, they were launching the second phase of that scheme called SAB Zenzele Kabili. So we went across the country one more time, presenting to taverners from Vosloorus to Malmesbury to Mafikeng, all the way to Potchefstroom. We were presenting to these retailers, explaining how Zenzele worked. As many of you know, Zenzele has now been extended to the general black public by listing on the Johannesburg Stock Exchange, but on the what they call the transformation side of the JSE. Jeff is going to spend a little bit of time also going through Zenzele Kabili as an investment and what the investment philosophy and business case is for that particular share. But many of you would have seen over the years, a lot of commentary has come from Greg Mahura Investments, particularly with Craig, who's the Chief Investment Officer in our business. He's really become the leading commentator, the thought leader as far as Black economic empowerment schemes are concerned. He's the go-to guy at 702, at MoneyWeb, CNBC Africa, SAFM, and SABC, to name a few. Whenever they need commentary around these schemes, they come to us and specifically to Craig on commentary on these schemes. What we've done for our own clients over the 13 years that we've been in existence is that every now and then when there's a milestone achieved in any one of the schemes, we would actually do presentations to our own clients. doing an in-depth analysis on the schemes, once again, looking at the dividend yields, looking at the returns, looking at the schemes that have worked, the schemes that haven't worked, and what to look out for. But at the core of all our presentations, which is really a big message for us to you today, is our philosophy is about creating a diversified investment portfolio. So often we get the difficult question of somebody coming to us and asking us, does this share that is launching, is it a good share or is it a bad share to buy? And our default line always is, to answer that question in isolation is actually not necessarily the right way to go. We always wanted our clients to understand that one share on its own has got a very different behavior profile to actually putting a portfolio of shares together. So we've always said to our clients, even if you're buying BEE shares, rather try to create a portfolio. This is really the reason why we've partnered with Tip One today to come and show you how someone can create a portfolio, a diversified pool of BEE shares for you, and how you can benefit from that. So to go on very quickly, those who don't know our business, when we started the business in 2008, we said we wanted to be the leading private wealth management company in the country. What we actually do as a business is that we're a diversified investment advisory and wealth management company. We do financial planning for individuals, we do financial planning for groups and for corporates. For individuals, we do anything from investment planning, risk management, retirement planning, and fiduciary services. Fiduciary services including trusts, wills, and administration of deceased estates. We've grown our asset base to about 1.4 billion rands of money that we manage on behalf of our clients, and we've got in the region of 1,500 individual and corporate clients. A lot have been achieved over the last 13 years of existence of our company, but what we really have been proud of is these three things, these accolades that have been bestowed upon us over that period. In 2018, we competed in what Intellidex called the top private banks and wealth manager survey across the country, and we were awarded the top wealth manager award in 2018. What is significant about that year is that we competed in about 7 categories and we won 5 of those categories, including lump sum investor, young professional, but the one that we're really proud of is the People's Choice Award, which is where your own clients vote for you versus the other companies voting for other companies' clients voting for those clients. And we won that award in 2017, 18, 2019 we came second, and we won that again in 2020. The second accolade is the FPI approved professional practice. The FPI is the Financial Planning Institute, and what is significant for us about this is that there's about 5,000 practices that belong to the FPI, and this award is only awarded to 14 practices across the country, and we are the only Black-owned and Black-managed practice across the country that has got this designation. The important thing about it is that they come into your business, or they come into our business and do a very deep due diligence, looking at our HR processes, our advice processes, our financial stability, etc., to name a few criteria that they look at, and they go through that process on a regular basis to ensure that we still meet the criteria. The last one, we are equally proud of it, and Masthead is our compliance officer. So every quarter, Masthead comes into our business to do an audit of our compliance processes, and then once a year, they submit those reports through to the FSCA to ensure that we are still complying with the regulations of the country. They started this seal called the Masthead Verified 5 Seal of Compliance, and in 2015, and they've awarded that seal to us every single year since 2015. And as I said, they only awarded to those companies that rate 85% and above in their compliance. When we say we were the top wealth manager in 2018, people are often not sure who we were competing against. And what this slide shows is an extract we pulled out from the Financial Mail in 2018, which goes to show you that we really had pitted ourselves against the best in the country. We're competing against the likes of Standard Private Bank. We're competing against PSG Wealth, Sanlam Private Wealth, and NFB Private Wealth Management. These are the companies that have been around for an incredibly long time. And for a business of our size, it was only 10 years old at the time, we were pretty proud of the achievement that we attained. Ladies and gents, I'm going to take you now very quickly through the investment principles that we think you should be able to think about when you consider investing in BEE shares. There's 10 factors that we believe influence your investment choice. So whenever you're investing in anything, whether it's a property, whether it's a share, whether it's a business, whatever it is that you're investing in, whether it's a retirement product, you must consider these 10 factors and how they're going to affect the return that you're going to generate on your investment. The first one is income generation. Look at how that asset has got the ability to generate income for you. So if you put your money in the bank, your income is your interest that you generate. If you buy a share, the income you generate is a dividend that you receive. If you buy property, the income that you receive is rental income. So look at the asset and say, what kind of income is this asset going to bring for me? The second one, which is very important, is the tax. What are the tax implications of the investment that you're doing? And often the tax implications relate to the structure that you use to invest in that particular asset. So what do I mean by that? So if you're going to buy BEE shares, if you buy them in your personal name, the tax implications are different to if you buy them in a company name or you buy them in the trust. For instance, if you buy them in your personal name, you are going to pay dividends tax when the dividends are paid at 20%. You're going to pay capital gains tax maybe as high as 18% when you sell those shares. And if you pass away, your estate is going to pay estate duty. However, if you buy them as a company, you will still pay, you will not even pay dividends tax when those dividends are actually declared, because you're declaring dividends from one company to the other, so there is no dividends tax. But if you do, the company does sell the shares, you will pay capital gains tax. And if you own the company in your own name, your estate will pay estate duty if you pass away. But if you buy them in the trust, you will actually pay much higher capital gains tax. You will pay dividends withholding tax at 20%, but you will not pay estate duty. So consider the tax implications of the asset by considering very carefully which structure you're going to use purchasing those shares. Liquidity, very important consideration, and Jeff will touch on this in his presentation. The liquidity we're talking about is how quickly can you turn your investment into cash? If you're buying a property, can you turn that asset into cash the very next day, or do you have to wait longer? And how quickly can you turn a share into cash? That's quite important, particularly for BEE shares, because the liquidity profile of the different shares is different. Flexibility, how responsive is your investment to the changes in your personal capacity? So if, for instance, you were to emigrate tomorrow, how quickly can your investment respond to the immigration decision that you've actually taken? As an example, the visibility is, can a portion of that asset be liquidated? Can you sell one room in a house? Or can you sell, if you've got 100 shares, can you sell 2 of those shares? So the divisibility of your investment is quite important. Geared returns, another incredibly important investment principle to consider, especially if you're going to buy BEE shares. Gearing is the debt that you use to get a bigger exposure in a particular share. This is specifically important for BEE shares because debt is used in different forms in buying the shares or the shares of the underlying company in BEE structures. Jeff will spend a bit of time showing you how this works and how it can work for you, and of course, how it can work against you. The bulkiness of the investment says, what is the size of the unit that you have to buy? If you're buying a property, you can't go to somebody and say, I'm going to buy one room at a time. You actually have to buy the entire unit at once. But if you're buying shares, you could actually buy small units at a time and build a bigger portfolio over time. The next one is control. How much control can you exercise on that asset? How much control do you have in terms of getting rid of the asset, taking the asset back, or influencing how that asset is actually managed? Costs. Another incredibly important decision or factor to consider when you're making investments. These are the costs of the transaction itself. If you're buying shares, you're going to pay STC, you're going to pay admin costs for your stockbroker. The holding cost is if you're holding onto the share, who's managing that share on your behalf. This is particularly important when you look at something like Tip 1, which has got both transaction costs and holding costs. And Jeff will take you through some of those when he does his presentation. But what is important about costs is not just the price that you pay, but it is the value that you're receiving. So often people don't want to pay for something, but only when they realize what value they are receiving for the cost that they are, the price that they're paying, do they actually consider it a good cost to spend on the value that you're receiving. And then the last one, very, very important, because often people think because they're buying BEE shares, there is no risk. And when we talk about risk here, we're talking about the potential for permanent capital loss. So whenever you consider risk is, when I buy this asset, when I buy this share, is it possible that I could lose all my money? And that decision is influenced by two things. But one is obviously the price that you pay for it. But secondly is how long you hold on to that particular asset, and can it recover the losses that it makes over time. So specifically talking about BEE shares or shares in general, these are generally long-term investments that so your mentality needs to be, when I'm going into this asset, I need to be a patient investor. I need to give this share, this portfolio, this group of assets that I'm purchasing time for me to see full value over that period of time. In the short term, you can make lots of losses, but they're only permanent when you sell those particular assets. So just before I close, what we've just done now in the next slide is to say, when people come to us and say, do I buy BEE shares? We say, what does your entire portfolio actually look like? And then what we then ask our clients to do in general is to say, assess your entire portfolio on the 10 factors that we've given you. So I'm not going to go through each one of them in detail. I'm just going to use maybe rental property as an example and BEE shares to show you how you measure and assess those 10 factors. You can see, for instance, we see in rental property, the income is a bit neutral. So neutral is orange, very good is green, and not so great is red. In BEE shares, it's also neutral. In rental property, you know, if you own one, sometimes your tenant pays and sometimes they don't. BEE shares, some of them you get dividends, some of them you get nothing because the dividends are used to pay off the debt. On the tax side, on the property side, fairly neutral. Capital gains tax you may pay, and depending on what your base cost is, you can actually get very good tax breaks. On the BEE shares, exactly the same, based on the structure that you've put in place, as I explained earlier on. Liquidity, property is not very liquid. You know, it takes you a while to actually turn that asset into cash. BEE shares, neutral. Why is it neutral? Some of them you can sell tomorrow, others you locked in for a period of time. Flexibility, once you've got the property, you've got it. There's not much else you can do with it. With BEE shares, of course, you get a little bit of flexibility. Some of them you can sell on the secondary market, etc. Divisibility, a property is a property. As I said, you can't buy one room in a house, but with BEE shares and ordinary shares, you can sell a portion of those shares that you own. Geared returns, both those assets very good. As most of you know, if you're buying a property, you often only need 10% of your own money. The rest is borrowed from the bank. And if your property grows at a rate faster than the rate of interest that you're paying, then you're making a very good return. Same with BEE shares. A lot of them use debt to create value for you. Bulkiness, you can see the rental property is quite bulky. It's a lumpy thing that you're purchasing. But with BEE shares and shares in general, you are buying things that you can bulk up over a period of time. With the property, though, you've got full control. You can decide what to do with it tomorrow. When you're buying shares or buying BEE shares, often you don't have full control because the board of directors decides how the BEE share works, and you also can't control what the company does internally. Costs, you know the costs involved in buying property. Some BEE shares are quite cost effective, depending on which ones you are purchasing and where you're purchasing them. And then finally, very important, please remember, whether you're buying a normal share or you're buying a BEE share, the risk is often very similar. Maybe it's curtailed a little bit in a BEE share because often there's a discount that you're receiving, but sometimes there is no discounts, as Jeff will show you later on as well. So, ladies and gents, why did we partner with Tip One in this seminar that we're doing for you today? We really believe there's a lot of challenges that BEE investors are facing, particularly with these public shares. However, a lot of them have got great value trapped in them. They've got very good underlying companies that they've invested in, and you're getting these shares at a very deep discount to their net asset value. And Jeff will demonstrate that in the next presentation. Demonstrate that to you in the next presentation. The other problem is they're all traded on different platforms. Some of them are listed on the Johannesburg Stock Exchange, others you have to buy over the counter, others are not even available to the general public. The third challenge is admin hassles. So a lot of clients would say to me, I've got Cecil shares, I've got MTM shares, I don't even know where my certificates are, I don't know how much I bought. So it's an absolute admin hassle just to manage these shares. So consolidating the information, getting information from different platforms becomes a bit of a problem. The bigger problem though is lack of investment knowledge. A lot of us simply don't know when to buy the share, when to sell it, and what reasons we put forward in either buying or selling that particular share. These deals are not easy. Even if you look at the SAB Zenzele Kabili one that launched last week, understanding what the deal structure is behind the scenes is not easy. A lot of us don't have investment teams to analyze these shares, to determine whether the price that we're paying is a good price, to understand how the debt in those shares actually works, how it's going to be paid off, and how you're going to realize value. So these deals are quite complex to actually understand. And then the last reason is low liquidity. Those who've bought big bulk of these shares in the past understand what the hassle it is for them when they try to sell some of those shares back in the market. Because not everybody, one, is trading on the platforms where they're listed, but two, not everybody has got the kind of money required to buy those shares from them. And the reason we're here today, we really do think that Tip 1 as an instrument, as a security, goes a very long way in alleviating some of these problems that our BEE shareholders have experienced over the last 13, 14, 15 years of buying into these BEE shares. So ladies and gents, that's really my story this evening, to say to you, please listen to Jeff next, listen to how the shares are being analyzed, and let's talk about how we can create diversified share portfolios in the BEE space using Tip 1. So Jeff, I'm going to hand over to you now.
Thanks, Kagiso. As I was introduced, I'm Jeff Blount. My primary role within Tip 1 is to look at and analyze the deal flows and the potential investment opportunities that present themselves to Tip 1 in the BEE scheme investment space. However, before I begin, perhaps it's worth just giving you a 2-minute overview of what Tip 1 itself is. So Tip 1 is a share that is listed on the ZAR-X stock exchange. It's essentially an investment holding company that's building a portfolio of what we believe are attractively priced and structured BEE schemes, which are in turn invested into JSE listed companies. So the argument goes, well, why buy and build a portfolio of MTN and MultiChoice and some other companies and pay their full market price on the JSE when you can actually access these companies via their BEE schemes at much more attractive prices. So Tip 1 itself is even though it's listed on ZAR-X, is a permanently and majority owned and controlled black company. Its listing structures allow us to issue shares as the company grows and as we get more investors, very much like a unit trust will issue units to investors. And so we're able to grow the business and grow the portfolio as we get new investors on board. I will unpack a little bit more on Tip 1 in a moment in terms of the administration side of things. But perhaps let's kick off with what you're here to hear and what you want to understand a little bit more about. So we estimate that over the last number of years, BEE schemes have participated or own more than 400 billion rand of listed equity on the Johannesburg Stock Exchange. So that's quite a bulky number. We estimate that this has been via in excess of 138 schemes that have been created at various stages of their life cycle on the market. In our world, we divide these BEE schemes into 4 categories or four types, 3 of which we are interested in to look at as investment opportunities. The most prominent and the ones that catch the headlines are what we call the listed BEE schemes. So the listed BE schemes are SAB, Zenzele, Kabili. Obviously, that's very topical. It came to market last Friday. But there's also a number of other ones. Motus has a scheme associated with it. You'll know about SOLBES 1 or Phuthuma Nathi, MTN Zakele, Futhi, Vodacom, Yebo, Yethu. Ukamba Holdings invests into Imperial. And essentially, these listed schemes are a BE scheme. And instead of investors buying and selling shares over the counter with each other or between each other, they trade on some of the stock exchanges or various stock exchanges. You'll notice there I do put one scheme there that's no longer with us. It's just to almost demonstrate the point of some of the attractive economics or returns that can be earned in these, and that's Welcome Yezani. So Welcome Yezani was the BE scheme that invested into Media 24. That was the media business that was part of Naspers. And Welcome Yezani was trading at about 7 Rand late last year when the scheme was taken out around 15, 16 Rand. So investors that had managed to buy shares at around 7 Rand actually did very well when the scheme was delisted. The second set of schemes that we have are what we call unlisted or privately held. So these are, and by far the majority of BE schemes are in this category. And these are typically special purpose vehicles or SPV vehicles, or they privately held companies with the sole purpose of pooling together a number of broad-based or direct black investors or strategic black investors into the scheme, and that will take a sizable chunk, a 10, 15, 20% stake of a listed company. And there's quite a number of these, I just put on the screen here a couple of companies that have strategic or BE schemes invested in them: Exaro, Roynert, Invicta, Sasol, and the like. Of interest, again, I just highlight here, African Bank, that scheme no longer exists, and investors that put money in that scheme actually lost all their money when African Bank went into liquidation. So while as much as you hear phenomenal stories about investors putting in 1,000 Rand and getting 700,000 Rand out of SAB, Zenzele, Kabili, there are also schemes that come with risk as well. So it's not just often enhanced returns that you get. The other category that we're interested in investing in or acquiring shares in would be schemes that are often owned by or participation by non-profit organizations, charities, or foundations, what we term empowerment endowments. And these would be strategic investors into listed companies, often with the objective of supporting broad-based beneficiaries around those foundations. The largest such scheme is, one of the largest is actually Siok Community Development Trust, which owns approximately 5 billion Rand of Kumba iron ore. The one set of schemes that we are not interested or can't invest in are typically those that are created for black staff within listed companies. So these would be employee share schemes or employee share trusts, and those are exclusively for the use of staff or employees at companies. And for obvious reasons, those are often not up for investment opportunities. So what do? We've got a great universe out there. We think there's an attractive universe, some great opportunities, some risky opportunities. What are we trying to achieve for our investors? The first one is we want to supply the service of and build a portfolio, what we call a professionally managed portfolio of a diversified range of BE schemes. Part of that is that we have to research, analyze, and select the underlying scheme assets. We think that the portfolio, to our knowledge, is the only accessible portfolio of such schemes in South Africa. And from an investment perspective, when we build this portfolio, we're obviously trying to give our investors access to a unique return stream. And that unique return stream is not just driven by the performance of the underlying company, but also the performance of the closing out of the discounts that exist in a BE scheme versus the underlying asset. And as you're aware, as many of these schemes approach maturity, those discounts close out, and at maturity, the scheme is closed, the assets are liquidated, or there's a return of capital, return of the net asset value to investors. And that's what we're trying to benefit in building a unique return stream for our investors. Another critical component is diversification and decorrelation. We want to build a portfolio and have lots of different schemes in our portfolio so that if one is doing well and one's not doing so well, you're not just having all your eggs in one basket of the scheme that's doing poorly. But by and large, on balance, if you've got a well-constructed portfolio, you're going to benefit and manage your risks of some of the schemes not doing so well, and hopefully, by and large, most of the schemes doing better. And then the final two components are around accessing complex transactions. Often these schemes are complex, and there's complex financial arrangements behind them. So not only do you have to understand the underlying company, but you also have to understand the scheme and the valuations around that scheme. And often these complex transactions are not readily available to the man in the street or to ordinary investors, just because they are what we'd call very user unfriendly. And we're trying to target those types of schemes as well. We often talk about the complexity premium. If you're willing to do the work to understand the complexity of something, sometimes there's a reward for understanding the complexity. Or alternatively, there's a warning sign. This is so complex, in fact, you might want to stay away. So before I go on to the really interesting stuff, which relates to some of the investment ideas we've got in the space, just to give you a feedback on our process. So we have to analyze and understand our investments from three components. The first one is the underlying company an attractive company? That's understanding the listed entity that the BE scheme invests into. And because we hope to, if we invest into a BE scheme, we hope to own that scheme to maturity till the a scheme hits maturity and is closed down and the assets distributed. You want to understand that you're going to hold the company for a long term. Are you willing to hold that company for a long term? What are the valuations around that company? The second thing we need to understand is the scheme itself attractively structured? And by that, we mean, is there economic transfer from the ordinary shareholders of the company, the ListCo, through to the BE scheme shareholders? In other words, are there discounts, or has there been special funding that's been provided, or low interest rate loans? Or were the shares issued from ListCo to the BE scheme at a nice discount? These are the things that we want to see, that there's actually an economic transfer and the creation of wealth in the BE scheme for its investors. We often joke that if the stockbrokers who are invested in the company like the scheme, don't like the scheme, they complain a lot about it because it's costing the ordinary shareholders money. There's a transfer to the scheme from the ordinary shareholders, and we like those. So often the more unpopular a scheme is with the investment community, those ordinary shareholders, the more we like it, because we know that there's this transfer. So the second aspect is the scheme itself attractively structured. And then the last one is the scheme or the price that you can buy in at attractively priced. There's a saying in the world of investments, and that's, how do you turn a great company into a bad investment? And that is that you overpay for it. No matter how good a company is, if you pay too much to buy the shares in it, you've made a bad investment. It could be, it's the same as a house. You could have the best house or buy the best house in a neighborhood, but if you pay way more than what that house is worth, even though it's the best house in the neighborhood, you've made a bad investment. You're probably not going to get a return. So in the framework I'm going to take you through in a moment, I'm going to show you just how we apply these three things in understanding our investment world. In the examples I talk through, I'm not going to unpack the nature of the underlying company because many of them will be known to you, and I'm rather going to just talk about the scheme itself. So what we have here is Vodacom Yebo Yethu. It owns approximately 6% of Vodacom, and that investment, to our mind, is worth 17 billion rand. We think that the fair price of Vodacom shares at the moment should be about 150 rand a share. It's trading at 130. So there immediately we actually think that there's opportunity in that the underlying company is slightly undervalued as in its listing price or its trading price on the stock exchange. But at our fair valuation, we think that the asset that Vodacom Yebo Yethu owns is worth roughly, call it 17 billion rand. But you've got to now look at the asset and you've got to understand then what is the liability, because most schemes, as Kagiso said earlier on, have debt in them. And you understand how much is their debt in and can it pay the interest the interest bill for that debt. And so we estimate that the liabilities in Yebo Yethu come to 11.6 billion rand, or thereabouts. There's also a tax liability there. But the debt funding cost is at 70% of prime. That's quite a good interest rate. I sometimes wish we could borrow money on our bonds for our houses at that kind of interest rate. But nevertheless, you've still got to meet that interest. So what that means is if I take the net asset, the 17 billion rand of Vodacom, I subtract the value of the liability, what it owes, it gives me what we think is a net asset value, or the net equity in Yebo Yethu, and that's 5.4 billion rand by our calculation, or 101 rand per listed Yebo Yethu share. And what happens is at maturity, that net equity, the scheme will get closed down, and that net equity, that 5.4 billion rand in today's money, or in today's valuation, will get distributed to shareholders, or they'll get 101 rand per Yebo Yethu share that they own. Now, what can you pay for this asset? Well, you can buy Yebo Yethu at the moment at 42 rand a share. So we think that's an attractive investment, 42 rand. It's worth 101 rand to our calculations. So there's some nice upside, and you also enjoy a dividend out of that. But there's one problem here. Yebo Yethu matures in 2028. So all else being equal, if nothing changes and you were to wait to 2028 in today's pricing and all metrics the same, you'd put 42 rand in and you'd get 101 rand out. That's roughly 2.5 times your money back over the next 7 years. Now, that's not a bad return. We actually quite like that as a return. But there is quite a long horizon to wait before you get that realization of the asset. So that's the one drawback in making these valuations, and also the need to be patient. If, as Yebo Yethu sits, if it was in our portfolio, we'd have to hold it to that end period. However, I just want to make one note there, is that 101 rand return of asset to the shareholders of Yebo Yethu assumes that Vodacom will be trading at 150 rand in 2028. We think the fair value today is 150 rand in today's money. So more than likely, the Vodacom share price is going to be more than 150 rand in 7 years' time, even if it just grows with inflation, which means that there's actually potential more value to be returned to shareholders. Another interesting investment idea that we like is Zakele Futhi. Zakele Futhi, as you know, owns roughly 4% of MTN, the other big mobile network operator. We think that the fair value of MTN shares is 140 rand at the moment. It currently trades around 100 rand. So we also think that MTN, the company itself, is slightly undervalued. And if we put that price into our assessment, we think that the asset that Zakele Futhi owns is worth 10.7 billion rand. And I must just caution here, though, there is quite a complex liability structure. The loan, the money that MTN Zakele owns, that it originally, the debt it took on to buy these shares, is relatively complex. But nevertheless, if you take the asset less the liability, it gives you about net equity of 5.1 billion rand. So the net asset value, the total net asset value of Zakele Futhi is roughly, call it 5 billion rand, which is around 41 rand a share. And right now, Zakele Futhi is trading at around 13 rand. When the scheme matures in November 2024, which is a nearer horizon, call it roughly 3 years from here, the value that will get returned to investors is the net asset value. So you put 13 rand in and you can potentially get as much as 41 rand out. And that's 3 times your money back. Now, that's an attractive return, but like everything, there's a risk here. And the problem is that right now, MTN has not been paying, and it has passed its dividends. And so there's no cash flow. MTN Zakele Futhi is not getting any dividends from MTN to service its debt. And as a result, MTN itself has had to step in and lend money to Zakele Futhi to service the debt. And that creates risk in assessing this business, because, you know, as much as you might say, well, the underlying asset is attractive and it's got a net asset value, the truth is, will it be able to service the debt? And so that's one of the risks that you face in MTN Zakele Futhi. Another scheme that you will be familiar with, no doubt, is Phuthuma Nathi. Phuthuma Nathi owns 25% of MultiChoice South Africa. And I just want to differentiate that. The listed share that we see on the stock exchange is MultiChoice Group, which has two components. It's got MultiChoice South Africa, and it has MultiChoice, the rest of the operations outside South Africa on the continent. And so therefore, this Phuthuma Nathi only owns 25% of MultiChoice South Africa. Of interest, MultiChoice Group is 60 billion rand, which includes the African operations and the South African operations. The African operations actually lose money, but the South African operations are incredibly profitable. And we think that the South African operations are worth 62 billion rand. So if you, very simple maths, if you take a quarter of 62 billion rand, that gives you net equity or net asset value of 15.6 billion rand in Phuthuma Nathi, in MultiChoice South Africa, which is roughly 231 rand per Phuthuma Nathi share. Currently it's trading at 138. But there's a caveat here. Unlike the schemes that we've mentioned so far, and unlike most PE schemes, there is no maturity date here. So Phuthuma Nathi is listed into perpetuity. So it's not like in 3 years' time or 5 years' time, they're going to close the scheme down, sell the asset, and give the net asset value to its shareholders. What you've got here is the risk that this discount never closes out. It's a structural, permanent discount that will sit between what the Phuthuma Nathi share price trades at and the underlying net asset value. Nevertheless, we still think that this is a very attractive asset. We know that MultiChoice is a mature business. It's not a high growth business, and it is getting competition from other digital platforms such as Netflix. But for example, it's defending that in South Africa with Showmax. But we like the business. It generates a lot of cash flow, a strong cash out of the business. And as a result, any dividends, 25% of the dividends that, or the profit that MultiChoice declares, MultiChoice South Africa, flow to Phuthuma Nathi, and they pay it on to their shareholders as dividends. At the moment, current share prices, that means there's a 16% dividend yield in Phuthuma Nathi. Now, we really like that. However, there's another trick we think that you can do with Phuthuma Nathi. Because it has no debt in the scheme and it offers a very high yield, one of the ways we can enhance the returns is to use leverage, and that's to borrow some money to buy Phuthuma Nathi shares. This is of interest. One of the factors that Hiso mentioned earlier on about potentially using leverage to enhance your returns. So your one option is you can just buy Phuthuma Nathi and you can hold it, and you hope the share price goes up over time, which we believe it will, even just by the inflation rate, and it gives you a nice cash flow, a nice yield out of there. But what happens if you were to borrow some money or use leverage, fancy term for going to the bank and borrowing some money? So I'm going to give you an example here. We can invest, and we've got an arrangement via a special purpose vehicle to purchase Phuthuma Nathi shares. We as tip one can put 40 Rand in, and First National Bank lends another 60 Rand into this portfolio. So you've now invested 40 Rand, but you own 100 Rand of Phuthuma Nathi, and off that you're going to get a 16 Rand dividend, a 16% dividend yield at the moment. After 4 years, we estimate, a little bit more than 4 years, we estimate that the interest in the capital can get paid off in terms of the dividends that we receive from the scheme. And as a result, once that interest and dividends is paid off, it's closer to 5 years, but because they only declare dividends once a year, we do a little bit of rounding off here. But at the end of that period, you now own 100 Rand of Phuthuma Nathi with no debt. So you put 40 Rand in, you now at the end of the period when the debt is paid off, own 100 Rand asset. You're getting 2.5 times your money back. That's an attractive return over that period. And thereafter, you will now get dividends on 100 Rand asset, which we like. If you wanted to, at that point in time, you could say, well, let's go to the bank and borrow another 60 Rand against this investment, because you're now in 100 Rand of Phuthuma Nathi shares. We borrow another 60 Rand against that, and we start it over again. And what do we do with that borrowed 60 Rand? We could pass it back to our investors or our shareholders. So in a way, by using leverage in Phuthuma Nathi, you can create every few years the ability to actually do a capital extraction or draw money out of that. It's like drawing money out of your bond on your house. Every now and again when the house gets paid off, you can draw money off that bond and we can return it to our shareholders. So we think that's a very elegant and attractive way of enhancing returns in Phuthuma Nathi. Another route, another share at the moment, which is topical and everyone loves it, or so when you look at the market, is South African breweries Zenzele Kabili. Now, I'm afraid that this is using our analysis. Great company. We like the company AB InBev over time. It's got a lot of debt in it, but we do like the business. We think this is a well-structured scheme. But when it listed last Friday on the market, it came to market, I think at the anticipated price was 40 Rand a share. It started trading at 50 Rand. It shot up to 150, and I actually think it went to 180 at one stage. So let's unpack the scheme here and see if this is a good investment right now, based more just on price. So the asset is AB InBev, is that Zenzele Kabili owns 5.7 billion Rand of AB InBev shares. It's got 3 billion Rand of debt, funded at 70% of prime, which is very nice. That's again a low interest rate. Therefore, it gives you a net equity of roughly 2.7 billion Rand. I take the current asset, I take the debt, and it says that it's got net asset value of 2.7 billion Rand. If I divide that by the number of Zenzele Kabili shares in issue, roughly comes to 61 Rand a share. Trading at 150, so I think right now 180, I think that's quite expensive. I suspect that over time I would avoid this and wait for the share price to come down, or wait for the debt, or wait for the AB InBev share price to go up over time. So apart from the fact that it looks overvalued at the moment, and I think that's just because there's a little bit of euphoria. Everyone saw the massive returns everyone made in the previous scheme, so they think that can repeat themselves and they've bid the share up too high. But the other risk that you face here is what we call liquidity, and it's not dissimilar to the MTN Zakele Futhi matter. So right now, even at the low interest rates that Zenzele Kabili has to pay the debt off that funded this purchase, there's not enough dividends coming out of AB InBev to fund that. So prior to COVID, AB InBev declared a €1.30 dividend, times that by 16, 17 Rand to get it into rands. Through COVID, they cut their dividend to half a euro. And we estimate that the break-even dividend that AB InBev has to pay for Zenzele Kabili to get enough cash flow just to pay the interest is €1.65. So we think that in the near term, there could be some liquidity issues here. No doubt AB InBev will assist, like MTN is assisting Zakele Futhi, but it is a risk that you face. Just of interest, there is a headline out there, it's going around that SAB Zenzele Kabili pays a 25% dividend yield. That's not correct. What it does do is it says is that 25% of the dividends Zenzele Kabili gets from AB InBev will be paid out to its investors as cash. So only 75% of the dividend it gets will be retained to pay the interest on the debt. This scheme has a long maturity date. It matures in 2031. And notwithstanding the very expensive price of Zenzele Kabili at the moment, I think over time, this will probably turn out to be an attractive investment, provided you don't pay too much today to buy it. And the reason for that is because over time, if the debt slowly gets paid down, and the AB InBev share price, call it roughly 1,000 Rand at the moment, I think in 10 years' time will be significantly higher than these levels. So you can imagine what you've got is you've got the underlying asset going up, you've got the debt staying the same or initially going up, but then coming down over time. And this creates, I think, potentially a long-term attractive investment, but not at these prices. Another interesting one, before I move on to some of the unlisted ideas, or at least the concepts around the unlisted ideas, is SOLBES. This is just one of the other listed B shares on the market. It's a little bit different to the shares that I've been talking about so far, which really are sort of geared, potentially geared exposures to via a B scheme to an unlisted company. SOLB1 shares are exactly the same as a normal Sasol share. They are just listed on the transformation section of the JSE. So it's exactly the same as an ordinary share. Only black investors can buy it. There's no liability here. So one SOLB1 share is the same as an ordinary Sasol share. So really what you're buying here is something linked to the prospects of Sasol. If Sasol does well, you should expect this share potentially over time to do well. Of interest, on average, SOLB1 has traded at about a 30% discount over time to Sasol shares. So it's 30% cheaper. Right now, it's 50% cheaper than the Sasol share price. But just be careful here. There's no maturity date here. So it's a bit like Phuthuma Nathi in that there's it's not like in 5 years' time, SOLB1 gets shut down and you're going to get given the value of each Sasol share. So there's no mechanism that closes that discount out over time. We just note right now the discount is probably wider than it typically trades at over its historic averages. So why would you buy it? Well, you really are not going to take a view on the Sasol share price. Sasol, in the midst of the COVID pandemic last year, it went to nearly 20 Rand. There were question marks about whether the company would survive, not just because the oil price dropped during COVID, but also because Sasol had invested and a huge amount of money in Lake Charles plant in Louisiana in the States. And that project has turned out to cost probably $4 to $5 billion more than what it had been budgeted for. And at the same time, it was behind schedule. So as a result, Sasol had cash flow problems servicing a lot of the debt around this project. And so there were question marks over Sasol's future. Sasol subsequently has recovered to 247 Rand, and the SOLB1 share price has moved from 70 Rand to 117 Rand over the last year. So what are the prospects for Sasol? We think it's quite dangerous to try and get accurate forecasts about the future, especially long-term forecasts. But we do know that most stockbroker research analysts out there are 10 stockbroker research analysts covering the stock in South Africa, and only one thinks it's a sell. The rest are, well, two are neutral, and then the majority like this company and think that the prospects for Sasol are good. It's settling down its debt. It's selling off some non-core assets. It's selling some other assets, which probably you don't want to sell in the long term, but it's raising cash. It's cut costs. And so therefore, I think that Sasol's prospects are looking decidedly better than they have for some time. The real question here is, will Sasol resume dividends? Because it hasn't paid dividends. And the reason why dividends are important is if SOLB1 trades at half the price of Sasol, and Sasol is paying on 200 Rand, a 10 Rand, a 200 Rand, a 10 Rand dividend, that's a 5% dividend yield. But if you can buy that same share, the SOLB1s for 100 Rand, you still get a 10 Rand dividend. So you can get as much as double the dividend yield out of SOLB1 that you could get out of Sasol. And again, we like that idea around potential opportunities there. So that's just a couple of the listed schemes. If you go into the unlisted market, or the privately owned or privately held B schemes, the SPVs out there, the economics is very similar, and I'll show you just a quick model in a moment how they work. But just to highlight, there's two ways in which tip one can acquire into the unlisted schemes. The first one is we can swap in to those schemes. And basically what happens is, let's say you have a B scheme out there. Often these schemes have a couple of anchor tenants, strategic investors that are in the scheme, and they're there for strategic reasons for the listed company underneath it. But often there are broad-based investors as well, or a smattering of investors in the scheme. And often these schemes do allow participating members to exit if they obviously get approval from the scheme, but at the same time replace themselves with an equivalent investor, essentially a swap. So let's just say you had an investor that owns 100,000 Rand or 1 million Rand in a scheme B, scheme one. It's a big scheme. It's worth 1 billion Rand, say, but they've got a small slice of that. We could either pay part of cash for that, or our preferred route in the unlisted space is to actually use our currency of tip one shares to pay. Instead of paying 1 million Rand cash, we'd pay 1 million Rands worth of shares in tip 1 to the vendor, and tip 1 just becomes an investor in the BE scheme, and it just sits alongside the other investors in the BE scheme, waiting for maturity, waiting for the scheme to realize its value. The vendor or the seller now owns shares in tip 1 and has solved a few problems. The one is that they now own a diversified portfolio, and that's very attractive because you don't now have you don't have all your eggs in one basket. You've got a diversified range of investments in the portfolio. The second one is that if you wanted to, you could sell the share, and we'll talk about liquidity in tip 1 in a moment. The third one is you could just hold it. Potentially, you could go to the bank and borrow against it as well. So there's a few problems that we believe the swap mechanism solves for existing investors in BE schemes. But apart from that, the mechanics are very, very similar. This is a working example. It's an opportunity we are exploring at the moment. And just to say that the reason why I can't run through and say, well, these are the unlisted or privately held BE schemes we're talking to, is because often these are confidential conversations or subject to non-disclosure agreements, and the fact that the underlying companies are listed means that they could have an impact on their listed share price. Whereas if we just were to go into the market and buy MTN, Zakele, Futhi shares via our stockbroker, that's just ordinary trading in the market. Nevertheless, this is, the economics in these structures are the same. As an asset, the scheme owns 100 million rand of Lisco shares. It's got 60 million rand of debt in it. Therefore, it's got net asset value or net equity of 40 million rand. There's enough dividend flow from the asset, from the share, the 100 million rand shares that it owns, pay a nice dividend. And as a result, it covers the interest and capital on that. We think that the scheme or the asset we could possibly buy for 20 million rand. So you buy it for 20 million rand, you've got net equity or net asset value of 40 million rand, you've got 5 years to go. And over time, what we believe is that the underlying share price, the underlying Lisco share price, the 100 million rand investment will rise over time. We've bought it for 20 million. The debt's going to get slowly paid off. And what you'll get is that the net asset value will rise quite dramatically, we believe, over time, so that at maturity, when the scheme is closed down and we can sell the shares and we can liquidate and get the net asset value out, that you also get a few times your money back, maybe 2, 3, 4 times your investment back. So this just gives you a feel for how some of these schemes work. This is just a picture showing what I've just explained. And in this example, this scheme has less gearing. So we believe that there's a potential acquisition price using, this is just an example. It's a picture to say we can buy into a scheme at 750 Rand. We think the fair value on the scheme is 850 at the moment. That's the net asset value, but the underlying market value is 1,000 Rand. And what we believe is over the next 2 or 3 years, that your market value will go to, say, 2,000 Rand, but you bought the asset for 750. So you're going to get a much better return than if you're an ordinary investor. But it makes, just to highlight here, that these maturity events, what we call liquidity events, when the scheme matures and the assets can get distributed to the shareholders of the scheme, are lumpy, and they make up most of your total return. And so therefore, the portfolios that we are building in tip 1, we talk about long-term lumpy returns. And you can see just in the schematic here that as we build a portfolio and diversify the portfolio, there'll be different maturity dates over time. And those different maturity dates over time mean that you will get periodic return of cash to shareholders. So in our world, when a scheme matures and we get distributed the net equity or the net asset value of that scheme, we want to give it back to our shareholders in the form of a special dividend. And so tip 1 is not going to pay regular dividends. If you want regular dividends, then look at buying a Phuthuma Nathi directly, for example. Some of our shares do pay regular dividends, and we may return those on an ongoing basis to shareholders. But most of your return here is about rising in net asset value as each of these schemes mature. And then we give at maturity of each scheme, you'll get a lump sum or payment back to shareholders. My last thing on this one is we often get asked the question, well, how long should I, if I'm buying shares here, how long should I buy shares for? our view would be is that because the average scheme that we're looking at typically has a 5-year maturity, some have got longer. Zenzele, Kabili now 2031 is 10 years out, some are shorter. You want to be willing to own the tip one shares through to at least the maturity of some of these schemes when you get your lump sums money back, because that's when the 100 Rand you put in scheme A in 3 or 4 years' time might be worth 500 Rand that we invest into scheme A. So that's when you get your multiples of your money back, is on those lumpy returns. So our suggestion is obviously that you come in for the long term. Tip one itself, and I'll talk about show it in a moment. In fact, I can talk about it right now. Is a listed entity, and its shares trade on the ZAR-X stock exchange as they trade as they would trade. It's no different to the JSE, for example. But our tip one structure ensures that we're always majority black owned and controlled. Just of interest, the codes of good practice, the BE codes of good practice, do allow, for example, mandated investors to invest into listed entities as well. And it doesn't dilute down, from the code's perspective, shareholding from a BE perspective. And why that's very useful for us is as we build the portfolio, we are engaging and talking to selected mandated investors to come in and potentially come in and also invest in tip one. And what that does, it gives us price discovery, and we believe will create liquidity over time in the instrument. Our fees in tip one, the annual fees are 1.35% of assets under management. For those of you that have invested in funds and unit trusts, I no doubt GMI will have advised you on this. Unit trusts, actively managed general equity unit trusts, typically have fees around 1.25%. Private equity investments typically have fees of 2%, and our fees slightly in the middle, closer to listed fees. And that's just because of the nature of what we do and the complexity of what we do. We also have some direct costs associated with tip one, and that's just direct costs associated with being listed, our listing fees, our audit fees, compliance fees, etc. We're listed on ZAR-X, as I said. SNG Grant Thornton, our auditors, our listing advisor that ensures we stay compliant with listing requirements is Quesco, and Computer Share, our transfer secretaries and validation agents. In the interest of time, I'm not going to dwell too much on our governance structures. Suffice to say that we've got a really great team in terms of the board of directors. A majority of the directors are independent and come with accounting, legal, deal structuring skills, financial planning skills, etc., which brings a great mix of skill sets into our board. And likewise, our investment committee has a similar mix of skills, including from our investment advisor. So we have our investment advisor. We do some of the work ourselves. We do a lot of the research that we do comes from our investment advisor, and we have access to a large team of analysts behind that. So in summary, we do believe and we are aiming to solve a lot of the challenges that exist in the BE scheme space. We're wanting to harvest a lot of these opportunities, many, as Kagiso went through. But just to remind you, we're building a diversified and professionally managed portfolio of BE schemes. We're targeting a growth in the net asset value of our investments, not regular recurring dividend flows. We think we've got a unique return stream, the only investable instrument of its sort in South Africa. We've got diversification and assets that are decorrelated, and obviously we're wanting to offer attractive returns to patient investors. Now, I have to put up the disclaimer at the end of this. This is just to say that everything I've said now, I'm not responsible for. I can't hear if anyone's laughing or smiling, so I presume that that's well received. So with that, I'm going to hand back over to Kagiso. Thanks very much, and I look forward to the questions at the end of the session.
Thank you, Jeff. Thank you very much. The questions are coming in thick and fast, and we'll address them very, very shortly. So ladies and gents, as I said earlier on, our last presenter is Limau. Limau is going to do a very quick investment process. So I think another about 7 minutes or so, and then we'll delve directly into the questions. So I've been warned not to say ladies and gentlemen, I must say everyone, so that everyone is included. So
Sure.
everyone, I'm going to hand over now to Lemao to do the investment process. Thanks, Lemao, over to you.
Thank you, Kahisho and Jeff, for the introductions as well as the previous presentations. As introduced, hello everyone. I'll be taking you through the investment process of how to invest in tip 1. So just as a starting point, I would just like to start by making a disclaimer before I continue with my presentation. We've been in contact with the exchange, with the ZAR-X, over the last week and a half. They're currently busy with the data migration. So because of that data migration, their app and the website are currently unavailable. But what they have indicated is that anyone looking to invest can contact a list of one of their accredited market participants or stockbrokers. We have a list at the end of my presentation, but you can also refer to the website for a comprehensive list of their market participants. But this is just to simulate what would typically work under normal circumstances when the website and app are both up and running. So as a starting point, I'll just like to direct you to our webpage, as in the tip 1 webpage. So this is what the landing page looks like on our homepage. There's a tab there that says buy tip 1 share. If you click on that, it redirects you to the ZAR-X page to enable you to actually start the registration process. Once you've completed the registration process, then you'll be able to buy shares in tip 1. Now, the landing page on the ZAR-X website has 4 parts. The first part here, ZAR-X Investor, that's the tab that you would click on if you're looking to invest in one of the companies that are listed on the ZAR-X. The second one, ZAR-X Company, that's the tab that you would click on if you are a company looking to actually list on the ZAR-X stock exchange. The third one, Listed Securities, just gives you a list of the companies that are currently listed on the ZAR-X. And then the fourth one is for brokers, market participants. So if you are either registered or looking to register as a market participant or broker on the ZAR-X platform. Briefly, we've just summarized the flowchart application process on the ZAR-X website. I've also got some screenshots as well, or we've been able to get some screenshots that just take you section by section what you can expect to see once you log on to the ZAR-X website or app once it's up and running. I'll just take you through each one bit by bit. So what you can expect to see is the first page here. This is where you just select the client type. So you would either register as an individual, natural person, or a juristic entity. So either a company or trust, or alternatively as a group, as a stokvel. So this is where you would complete those details along with the country that you're registering from. Then from there, you would be prompted to then complete your details. So as a natural person, it would be your name and surname along with your ID number. If you're a juristic person, then it would be the registered name of the entity along with the registration number of the entity as well. Then you'd be further prompted as a natural person to also complete your title, gender, race along with your date of birth. Preferred language along with your contact details being your email address as well as your cell phone number. Another neat feature of the app and the website is that they actually give you the option to do part of your figuring on the app or on the website. So they've designed it such that you should be able to take a photo of your ID along with the photo of your physical address. So here, this is where you'd be prompted to actually complete the details of your physical address. Then the next screen would be then selecting which bank you bank with. And then from there, you'll be redirected to a screen that'll request you to complete the details of the bank account. So namely your account number, account type, as well as the branch code as well. From there, then you'll be prompted to select which market participant / broker you'll select. For those of you that are not aware, to be able to trade shares on a platform such as a stock exchange, one can't do it directly. You actually need to go through a broker since they are accredited for FSCA and FICA and other regulatory purposes as well. So this is where you do the selection of the broker. And then once you've done that, then this is an indication of what the screen looks like once you've completed your online registration process. There may be a likelihood that there may be additional documents that you may need to send through to your broker/market participant. But should that be the case, then you'll be prompted to do so. The screen should show you the contact details of the market participant that you've selected. Then you'll just send them the additional documents that they still require. Then once that registration process is completed, then you're good to trade, and then you can start buying shares. In summary, I've just included here just a brief list of some of the market participants/brokers that are on the ZAR-X platform. But for a more comprehensive list, one can actually go to the ZAR-X website for a comprehensive list of the market participants and the stockbrokers. And that, everyone, summarizes my presentation, short and sweet. Thank you, everyone, for your time. I'll hand back to Kagiso Mahura.
Thank you very much, Limao. So what we're going to do now is go straight into some of the questions. Jeff, there's a couple of questions I think that are directed at you. But before I go to you, there's some of basic admin questions that have been asked. So the first one is the slides that we have. Are we going to be able to share those? And if so, what in those ones are we going to be able to share? So Jeff, do you want to take that one?
Yeah, so we are happy to, we will post onto our website, but we're also happy to share the slides. We are going to show, we will share a slightly edited version of the slides and take away some of the investment work that we presented. That's proprietary work, but the rest of the slides we're happy to share. Not just relating to the slides, but also I do understand that GMI is also happy to share the video, and we're happy for the video to go out, but the deck will be slightly edited, but the video will contain all the information I've just spoken through.
Yeah. So in simple terms, Zenzele, we will send the slides out, but you must understand that some of the information we have here is intellectual property, so we might have to take some of that info out, just obviously to protect some of that intellectual property. Okay. I've got two questions for you, Jeff. Two from Tunzi. Is tip 1 already available in the market? And I think part of that is being answered. And where is it available? And I think Limao has answered that. It's on the ZAR-X platform, as Limao has answered. Now, Tunzi's question, and I think you may have already answered it, is any comment on SAB's run on the trading to 180 from 45 Rand in the last trading days? Is it just the benefit? So this is the part I think is interesting. Is it just the benefit of poor BEE verification, or is it still to be supported?
I'm actually, I put it this way, I just think that there's a lot of euphoria around the stock. And I think people have just saw the previous returns and they've seen the headlines. But I think Limao can talk through the verification process that he's going through at the moment. We are ourselves trying to get verified to be able to purchase the scheme. So he can give you comment on the efficacy of the verification process.
Yes, thank you, Jeff, for that. Just to respond to that, there is quite a process to actually register for a company, as in a BE verification process that is underway if you want to invest in any of these companies. And I think to protect the interest of transformation, the people who are tasked with the responsibilities of the verification take their responsibility very seriously. So it's quite a layered level of assessment that's done in the company or the juristic person that's looking to do the investment. But once you've gone through that, I think they need to satisfy themselves around the benefit that's going to flow through either to the shareholders, the beneficiaries, or the members that should receive benefit from that particular juristic entity.
Okay, fantastic. Jeff, here's another interesting one. It's from anonymous attendee. So I think many members of the attendee family are here, all anonymous. Here's a few questions. do you foresee longevity in this type of schemes? Will government not have a sunset clause on these schemes?
It's a great question. The answer is no. I think until we see sustained and material transformation of the economic ownership patterns of South Africa, it's a mouthful. There will be requirements in South Africa for whether it's moral suasion or legislated suasion for companies to increase their black shareholding ownership. I suppose it won't be, they will do away with it when it's no longer required. And so what that, I don't know what that means. Does that mean that when 70% or 80% of listed companies are owned, percentage ownership is black ownership? Perhaps they do away with it because it's no longer required. But between now and then, I think that you will find that these structures and these schemes will remain in place and be part of the necessary landscape.
Okay. 2 questions in a row for you. Kula Sizwe. It's not part of the portfolio at the moment. And I think it's an important one to answer in terms of what's available and what's not available. And then the second one is for SOLBES, what happened? This one is from Emil Devchand. What has happened to the market maker arrangement with SOLBES 1?
So on Kula Sizwe, for those that don't know, that is the scheme that's associated with the Barlow World property. The reason why we have looked at it, but the reason why, by the way, there's a lot of shares that we like and have looked at in our universe that I haven't discussed today, but there's a practical purpose in that. I think that's Kula Sizwe was created in 2019, if I'm not mistaken, and I think it's for the first 3 years. Investors are not allowed to even exchange or trade shares. The intention is that they will list this on the market, I think in 2024 or 2025. But for the first 3 years of the scheme, if you've got a Kula Sizwe share certificate, you can't sell it.
It's the first 5 years.
Is it the first 5 years? Yeah. So some schemes are very strict like that, they don't allow investors to exchange or exit the scheme. It's a hard lock-in. That does reduce our universe a little bit. But once that hard lock-in is no longer in place, we will definitely be investigating.
So Kula Sizwe essentially is a 15-year scheme. The first 5 years is the hard lock-in, but after 5 years, they'll loosen that a bit, and I think that's the time that Tip 1 can start looking for some swaps out of that scheme.
Cool.
Correct?
Correct.
Absolutely. Now, here's an interesting one. I think there are a couple of aspects to it which you need to address. Is Tip 1 basically like an ETF? So you need to speak to whether it's an exchange-traded fund for BEE shares. Has it got a unitized price? I think there's an answer to that. What is the biggest holding in the portfolio at the moment? Okay,
it's a very good question. It is similar to an ETF for BEE shares. So it's a combination of, let's call it an ETF/unit trust. In the UK, you get things called OICs, open-ended investment companies. So it's essentially a pooled vehicle. So the answer is yes, it is. I just want to caveat one thing. An ETF, if someone wants to sell units in an ETF, you're obligated, or the ETF provider is obligated to provide liquidity and pay out the investors. Because of the long-term lock-ins and natures of some of our underlying investments, we don't link the price of Tip 1. The Tip 1 share price will trades on the market as a share, but it's not linked to the underlying net asset value of Tip 1. Because in an ETF, you're obligated to provide liquidity if investors sell. But if you bear in mind that our investment portfolio that we're building is, got 3, 5, 7, sometimes maybe 10-year horizons, we can't guarantee or meet that liquidity. In terms of our biggest holdings and what is it at the moment, our target portfolio, our initial target portfolio that we're building at the moment is allocations to 20 to 30% allocation to MTN Zakele Futhi, a 15 to 20% allocation to Vodacom Yebo Yethu, if as and when price moves into our price target, and a 40 to 50% allocation to the geared Phuthuma Nathi SPV. We're in the process of executing 2 of those allocations at the moment. But as and when, as a listed entity, as and when we make these acquisitions, we will make this publicly known via ZAPs, which is the ZAR-X equivalent of cents. The JSE has cents, ZAR-X has ZAPs.
Okay. Next question is from Keletso Malepe. What is your view on the YWBN scheme? I don't know if you're aware of it.
Young Women in Business scheme, if I'm not mistaken. I honestly can't comment. So yeah. Lamau?
No additional comments on my side there.
Okay. Another question. This one's from Lita. In the event that the BE investment matures inside tip 1, yeah, I think you alluded to this. Can you give us an idea of the proportion or the portion of that maturity value that will finally be declared as a dividend? In other words, what percentages will flow through to the shareholders after you've deducted your costs?
Yeah, so very simply put, let's just say that in 2024, we have 500 million rand of assets on our balance sheet, and there's investment in scheme A. Let's just say, for example, it's Yebo Yethu at that point in time, Zakele Futhi at that point in time, and there's 100 million rand realization of that asset. That 100 million rand we would return to shareholders. So roughly it would be the equivalent of a fifth of the assets on our balance sheet. Technically speaking, we would do that at that point in time, either by way of a special dividend or potentially a share buyback. But normally it would be a special dividend. The intention is not to hold uninvested cash on the balance sheet. That's one of the issues that we have with a number of existing sort of, let's call it, investment holding companies, where they sit with cash on their balance sheet. So our starting point is to return surplus cash to shareholders or surplus investments as and when those schemes mature.
Okay. I'm going to take, there's quite a few questions. I'll take a few of them now, and then maybe we'll close off. The first one is, I think you've answered it in explaining what sits in the portfolio at the moment, but there's a specific question about Ukamba 1 and 2, if they are in tip 1, and if not, why not?
Lamau, you want to go?
I was just going to say that Ukamba 1 and 2, we actually have done analyses and assessments around them. There's concerns around the pricing and also the underlying company at the moment. So as a result, we've decided not to pursue that. But there are other potential investments on our horizon. But we had previously considered Ukamba 1 and 2.
Okay. 2 more for you, Lamau. Pretty straightforward, I think, but I think we need to answer them again. Will stockpiles be allowed, or investment class be allowed to buy tip 1? And then the second one is, do you need to be a BE qualified person or entity to purchase tip 1 shares?
Okay, so I'll answer them in one go. Yes, stockpiles are allowed to invest into tip 1 as a group. There's something else in the pipeline, but for now, we'll just answer the question to say, yes, stockpiles are allowed to invest. TIP is open to everybody to invest. So we are open to institutional investors, companies, along with individuals and groups to be able to invest in our company. But it's important to understand that given our structure and given our mandate, we are structured to maintain a majority Black ownership at all times. So in that, our listing rules have been designed such that should there be a likelihood of that majority Black ownership being breached, then that potential investor wanting to come in will either not be able to come in or will be able to come in limited to the predetermined levels of majority black ownership in the company. But we are open to all people to invest in our company.
Fantastic. Jeff, two more for you. Would this portfolio ever extend to include government retail bonds? That's the first question, and that's from Anonymous as well. And I think there needs to be a little bit of clarity around the gearing. So the question is, can you elaborate on the process of taking out the loan to invest in these shares and how tip one assists in adding on to the amount to buy the shares? So I think there was a bit of a misunderstanding around the gearing structure that is used to purchase additional Phuthuma Nathi shares and how that works as far as the members or the investors are concerned.
Cool. So the answer is no. The objective of tip one, as per our founding documents and the objective of the investment objectives, is to buy into B schemes that are in turn invested in listed companies or large portions of listed companies. So this is an equity structured portfolio. It's equity. So tip one wouldn't be allocating cash on its balance sheet into government bonds or other type of instruments unless they had some kind of equity type payoff profile. If we had surplus cash on our balance sheet and we couldn't deploy it, we'd rather return it to our investors. The second question around gearing, no. So tip one is a listed share. We may, if it would enhance returns, some of the investments in tip one, for example, the Phuthuma Nathi. But you wouldn't want to go, if Phuthuma Nathi had a lot of debt in it already, we wouldn't want to go and borrow money to go and buy, to invest into something that already was geared, because then you're like borrowing money to invest into something that's already borrowed money. So that would be, the Phuthuma Nathi opportunity is more a unique circumstance rather than the norm. It's outside the norm. What I would say though is for investors wanting to borrow money to buy into tip one, I'd suggest that you chat to GMI around that. But generally, our view is unless it's very well considered and well structured, and you've got an investment that offers a very high yield, you want to be very circumspect around borrowing money to buy and speculate in shares. So my counsel would be is don't borrow money to buy shares in tip one.
Absolutely. Jeff, one more question. I think there are a couple of more other questions, but I think they have been addressed. I'm not, for the sake of time, I'm not going to repeat them. This one is quite interesting. Why go for listing, going as a listed company, as a share, instead of actually having created a unit trust or a collective investment scheme? It's a very good question. The problem, that's from Mbasa Gua, by the way.
Okay, cool. The problem with the regulations around listed or collective investment schemes or unit trusts, as they also exist in, for example, partly in ETFs, but different ones, is collective investment schemes don't allow you to buy unlisted investments. Now, remember, the vast majority of the targets that we will be investing in tip one are not going to be, for example, the MTN Zakele Futhis and the like. They will be unlisted, or they'll be going via SPVs, and collective investment schemes can't do that. So from a regulatory perspective, ideally, we would have loved to have gone that route, but from a regulatory perspective, we can't. And then the other potential risk there is, even if you could go, as I mentioned, into you could house tip one via an ETF or a collective investment scheme. If part of your portfolio is into unlisted SPVs where there is no liquidity and an investor, you need to meet a redemption, you can't sell the asset to meet the redemption. Can I just, Chris, again, maybe I could just also add just one thing which maybe I didn't dwell on in the discussions. You know, a lot of investors are if they've got the time and the effort and energy or the knowledge, or you know, can go and buy these shares themselves. You know, we're not out to replace that. You know, it's, you know, whether they be share schemes or whether you're building your own portfolio of normal listed companies on the JSE, many people do that. I suppose what we're saying here is that given sometimes the complexity in assessing and analyzing, in particular the BE scheme space, that if investors would rather come into a portfolio and build a similar portfolio, that's what we're looking to do. We're not out to replace individual investors and meet their and replace their investment decision making. The reason why I mention this is because we often get that question. By all means, do it yourself as well, and then you're not going to pay us the 1.35% fees. But at the same time, perhaps you know, for those that don't have the capabilities to do that, we think we're a compelling proposition.
Fantastic. Jeff, I'm actually glad you addressed that, because that is one of the questions that have come up. But I'm going to tell you in the context that it was put, which is actually quite interesting given your answer. As someone that says, I've done well in BEE shares, I've paid no fees, why would I buy tip one? Okay. And then the next part of that is, I need more information on the unlisted investments, which is exactly what those that are buying tip one are paying for. So this is really the point that's being made, is that in fact, you can go ahead and buy the shares yourself. But what tip one gives you is a lot more than the general information that it's out there, but also gives you access to the unlisted investments. It gives you access to investment expertise that you otherwise might not have to do the analysis on the underlying shares. So if you're doing well on your own, by all means, of course, continue to do that. But if you need more expertise and a diversified portfolio, that's what tip one will give you. Final question, Jeff, and then we can close the evening. It is two questions, but I'm going to wrap them in one. The first question was, what is the current price of tip one? And does the illiquidity of the BEE shares affect the price of tip one?
Very good question. So first of all, if there's a lot more questions that have come through, please by all means direct them via info@tip1 via our website. We would welcome those. I'm sure that also via GMI and when they share the deck or the video clip. Tip one at the moment, R1 a share on ZAR-X. We are in a capital raising process at the moment, what we call our retail capital raise. So we are issuing shares into the market at R1, and you can just it's a slightly different structure to the way the JSE works, but essentially you contact your market participant or ZAR-X stockbroker, or you open an account as Lamar would have shown you, and you place an order on the market, and the market will get fulfilled there at typically we're targeting R1 a share at the moment. In terms of the liquidity, this is our first roadshow, and we will be driving a number of retail initiatives across the marketplace to raise capital and interest and appetite in tip one. And we're also engaging a number of institutional investors to raise capital and interest in tip one. To give you a feel, at the moment, tip one only has 7 million shares in issue at the moment. We're very tiny. We're building our portfolio. And the structure allows us, as and when we get new investors into issue shares into the marketplace, like an ETF or a collective investment scheme. So two things are going to occur as we build the portfolio. The one is we think we've got some really attractive assets coming into the portfolio at significant discounts, and that's going to boost our net asset value. And secondly, the demand and the ability for us to target selected institutional investors to create liquidity and fund price discovery, we think is going to play a big role in driving that. I don't know if I've answered the question, so I hope I have.
I think you have. As I think we're closing, a couple of new ones have come in. We have booked time until 6, so I think I should put them in quickly, just to make sure that the people that are here get the full value of being on. So the one question is, how much money does Tip 1 have to invest, and will they come back to the shareholders to raise more capital? But I think you've addressed that. This is we are on a roadshow. This is your first capital raise that you're doing at the moment. So obviously, depending on how well that capital raise goes, you may come back into the market for further capital growth. And I know that there are other webinars that are being planned for the future and other roadshows to raise more capital. So the other question from Basa was, will the share be available on Easy Equities?
Lebao?
Currently, ZAR-X is the primary platform that we're using for the listing of the shares and the trading of the shares. But we may be exploring other opportunities in time to come. I'll leave it at that for the time being.
Fantastic. Jeff, I'm just scrolling back up quickly just to make sure that I've answered all the questions. Ladies and gentlemen, and everyone, just to make sure that everyone is covered, I really want to take this moment and thank you all for taking the time to be with us. I'm really hoping that the session was worth your while, that you've got a lot of your questions that have been answered. But if not, as Jeff said, info@tip1sa, Jeff, if I'm correct, tip1sa.co.za. Please put your questions.
.com, I believe.
.com. Put your questions through to the guys, and they will answer any of the questions. If you believe your question was not fully answered, or you want further elaboration on your question, or send it through to info@tip1sa.com, and the guys will come back to you. And if any of those questions are directed to us at GMI as well, the guys will forward them onto us, and we will respond to your questions. So if you have been on the webinar today, please do expect the recording to be sent to you on the email you had on the registration. And then, as we said, a toned down version of the presentation will be put on the tip1sa.com website for you to download in the next couple of days. So once again, on behalf of British Mahura Investments, Tip 1 SA, Jeff Plant, Lamal Titori, thank you very much, gentlemen, for your time. And ladies and gents and everyone, thank you for joining us this afternoon and into this evening. And we hope to see you at our next webinar. So from our side, thank you.